Good morning and welcome to the monthly press briefing that is after the Monetary Policy Committee meeting. The Monetary Policy Committee of the Central Bank of Kenya met yesterday, made its decision, and that decision was communicated via its usual press release. So as is customary, this morning we have a press conference that shall be addressed by the Governor of the Central Bank of Kenya, Dr. Njoroge. He will go through his statement, and as soon as he's done with his statement, we will go through, as we usually do, with questions and answers, which will come from you. As you've been doing over the past few months, this is all happening online, so you're free to send through your questions via the link that we've sent out to you. That is Slido. That's www.slido.com. The meeting ID is hashtag MPC01, MPC01. And as you send in your questions, you can do so, but please make sure you identify yourself by name and the institution you represent. But before all that, I would like to introduce and welcome the Governor of the Central Bank of Kenya, Dr. Njoroge.
Thank you, Alice, and good morning, colleagues, friends, ladies and gentlemen, wherever you are. And as was indicated, I will make a presentation covering the content of the MPC meeting that took place yesterday, and then, of course, at the end of it, take your questions. The MPC met yesterday to assess developments since its last meeting on June 25. And in terms of the global economic outlooks, these remain quite weak and highly uncertain. As a matter of fact, you have to go back to the Great Depression, which was the worst economic crisis in the history of the advanced economies, industrialized world, to have a crisis of the same magnitude. So this COVID crisis that we have today has been sharp and it has been intense. And by all indications, the recovery will be slow and quite uneven. But the point is today, the numbers that are coming through are still quite weak. But there is a lot of optimism and hope, more hope than optimism, I presume, with the developments in the health area. So in a sense, to overcome and to overcome the health crisis, with all the news that has come out, that we have received recently, I'm sure you've seen it, about the possibilities of having a vaccine for this COVID-19 virus. So that is the situation. But in terms of numbers, there has not been any new numbers in terms of overall global growth since our last discussion. So the general projections still are for a significant decline in the global economy. But what has happened now is there has been some new data, country-specific data, for Q2, the second quarter, which obviously is we are looking at it with, much more carefully. So, for instance, China announced 3.2% growth, and this is year on year, from a decline of 6.8% in Q1. So that was their Q2 data that came in recently. Now, there are some concerns about the alignment of the announced data with other data in the country, such as the PMIs, and indeed other data, considering that China is connected through trade to other significant economies such as the US. So in some sense, we need to look at it from both sides. And as a matter of fact, today the U.S. is expected to announce the Q2 data, their own Q2 data. So we are looking at those carefully. There has been other numbers, but the bottom line here is that the economic outlook still remains poor or bleak. And even as there has been reopening of various economies, lifting of the various lockdown sort of restrictions that were in place, and people are gradually going back to work, that whole process, and actually in some places they have actually ended up having reversing on the lifting of those restrictions. So things remain unsettled and quite uneven. Today I'll concentrate more on the domestic economic trends. And if you'll bear with me, I will present a lot more information about the domestic economic trends than we generally do. But so to begin with, what is clear is that agriculture sector in Kenya has been doing quite well. And as a matter of fact, the tea has been strong in terms of production and consequently also in terms of exports. There has been some numbers there in terms of production, and we expect focus for the year in terms of production is something in the order of 489 metric tons, 1,000 metric tons, compared to 459,000 metric tons last year. And the point here is that the favorable weather, there has been favorable weather. Now it's true there has been some concerns about fertilizer, the use of fertilizer in the small, by the smallholder tea growers. But all that put together, we still expect a 6.5% increase in terms of production, and that should be reflected also in terms of exports. So far during the quarter that just ended, there was a growth of 5.7%. Other numbers relate to cane production, for instance, cane deliveries, and those really have been quite much higher than cane deliveries in 2020. For instance, in the month of May, the cane deliveries were 59% higher than May of 2019. And frankly, from February right through May, the numbers have been, off the charts in terms of higher cane production following the increased acreage and favorable weather conditions that have been observed. Fresh fruits or fresh vegetables also, these largely for exports. The numbers there also have been, if you think of fresh vegetables, have right from January through June have been higher than the corresponding month last year. And as a matter of fact, in June, it was 78% higher than where it was in June of the previous year. And this, again, has been, despite the disruptions we have seen, both in terms of the international supply disruptions that we've seen in terms of in the destination countries, and also in the aircraft and, should we say, the cargo space and things like that, that has constrained our exports to those markets. Flowers, of course, is something that you are more familiar with. There has been more discussions about that, and I think there has been a lot of discussions about this. And bottom line here is that there has been an easing of the conditions, improving, the easing of the restrictions, and the markets have also improved quite a bit. I was going to quote the numbers on this, but I think we have already quoted them before. But I think the point here is after the dip that we had seen, the dip that we saw in April, there has been a substantial recovery. There are some numbers other numbers I can quote just now, if you don't mind. Yeah, in terms of the values in of exports, January to June, let's say, January to June, in 2020 we have it's 258 million US dollars. That's the value of exports, compared to 318 in 2019. But actually, the real difference is in April and May, where actually in April we had 29, we exported 29 million, as opposed to 45 million in 2019. In May, we exported already 35 million compared to 32 million in 2019. Actually, in June, we exported 28 million relative to 67 million in 2019. I have to hasten to add that the 67 million in 2019 was an outlier, significant outlier, because that actually benefited from interruptions in supply in a particular, let's say, one of our competitors, a country that exports into the same destination, and so we benefited from their lack of inability to export, hence that increase. But that was the only, let's say, outlier in this period. Bottom line is the performance in terms of cut flowers, as was indicated in the press release, is 80% of, in July, is 80% the volume that we had expected, that was in July 2019. So for the period July 1 to July 21, I believe, July 19th, it is 20% of the period, the entire month of July 2019. Let's move to other items. And I think the ones that I would want to flag relate to agriculture, crop production. And here, crop production looks much more favorable in terms of where they are. And if you don't mind, I'll mention yes, in terms of maize, for instance, we are expecting, there's a forecast of 42.9 million bags of maize production this year, and that compares to 39.8 million bags last year, so a growth of 7.7%. Bean production of beans, we expect something like 26% growth this year. Potato production also 14.2% this year growth. And this is performing well because of the improved weather conditions across the country. So we've really benefited from the better weather conditions, and the worries about locusts and things like that obviously are much more muted. Because the crop cycle is much more advanced, and I guess very shortly we'll begin the early harvest as we have it. Cement production, moving on to other items, cement production also has been quite strong, and just to mention this, right through the year from January, it has been much higher than it was in 2019. As a matter of fact, the growth rate, as it were, in January it was 9.3% higher, February 16% higher, and now in May 4.9% higher. April actually it was 1.4. So April there was it wasn't a dip really, it was just relative to 2019, it was still positive growth. So cement production appears to point to, or is pointing to, a strong growth in the sectors, the construction sectors and the building sectors and so forth. We could also talk about sugar production, but I want to stop there in terms of the specific leading indicators that we have in our domestic economy. All this point to recovery or point to strong growth in 2020, despite COVID. It is true there are some numbers that are not so strong, and some of these are puzzling. For instance, on daily production, where in the first 2 months, January, February, there appears to have been a significant decline that we still cannot explain. But anyway, there are numbers that obviously are a bit puzzling. Electricity consumption has also increased, but that appears to be driven by domestic consumers in terms of the large producers or large consumers, industrial consumers. That hasn't gone back to 2019 levels. But I think the point here is that overall electricity consumption has grown. So there are some numbers that are giving mixed signals, but I think on the whole, the trends as we have them are quite favorable for strong growth during this year 2020. I want to move on to the market perception survey that we have, and this will be, in the next few days, it will be published on our website, so you can wait for the details there. I just want to pick a few things from it. And the first, of course, is to explain that inflation expectations are well anchored. So all the respondents expected inflation to remain well anchored going forward. The other item here is a return in optimism. And there was a dip in the level of optimism as judged by what percentage of the population of the respondents were very optimistic or just optimistic in terms of the economy looking forward. And the low point actually was in May in terms of our surveys. And that showed 30% of respondents were either very optimistic or just optimistic, so a level of optimism of 30%. In July, that has recovered to 48%. So it definitely has improved. Now, there is also something else, which is the expectation of increased activity over the next 2 months. And non-banks, as you know, we do survey banks and non-banks, but I'll mention non-banks because they are the ones that are most hit by the COVID pandemic. So strong or moderate, those 55% of the respondents had their expectation of a strong or moderate, or had a strong expectation or had moderate expectation of increased activity, economic activity in the next 2 months. And this is an increase from 20% back in May, June. So you can already see that there's a little more optimism, sense of optimism in the economy as indicated by the respondents to the MPC survey. A surprising for some of us number in this is really relating to hotels. And as you can imagine, that has been one of the sectors that has been hit the hardest by the COVID pandemic. And we surveyed them, and I want to present to you some of the responses that they provided to us. It's interesting that about 60% of the hotels indicated that they would be open when international travel resumes after August 1. So looking forward, they expect to be open, and they are doing what they can to be open. Interestingly, in terms of hotel occupancy, now in January, according to the respondents, the average occupancy was something like 44%. And in February, it increased to 51%. Then in March, it fell to 24%. April, May, and June, obviously, rock bottom, something like 2%. These, I presume, are the people that were staying in hotels because of the quarantining and things like that. So they are 2%. And in July as well, it is at 2% in terms of looking forward. So now this is the average forward booking. Average forward bookings in July was 2%. August, it increases to 7%. September, 17%. October, 18%. That is interesting, that actually they are getting some forward bookings. Now, this is not obviously we would expect this to, would want this to be much higher, but at least it is the beginning of a recovery in the hotel sector. Interestingly, as well, we asked them also about their average forward booking, and I mentioned some of the numbers just now, but comparing where we were before and now, I want to mention just the maximum numbers, the mean and the maximum, just to be, I mentioned the means actually just now. But the maximums, in July, you have some hotel respondents that have bookings up to 10%. In August, it's up to 23%. In September, it's up to 56%. And in October, up to 52%. These are obviously to be confirmed. The bookings await confirmation. And of course, this will very much depend on the return on the international flights and reopening of international travel. But I think this is an interesting sort of snippet into the hotel sector, which obviously is significant in terms of GDP, in terms of employment, etc. Let's move on then to the balance of payments. We've mentioned in the press release that we issued yesterday that exports have grown by 1.7% in the first half year. And the dynamics there, I will not repeat them, but they revolve around a very strong tea. Despite the slightly lower price, the volumes have compensated for that. Recovery in flowers, or the flower sector, the floriculture sector. And interestingly, with regard to the flower sector, looking forward, the orders for flower exports are almost at normal levels. And the industry players are citing levels like 95%. So orders are pretty much back to normal levels. And with the easing of international travel, restrictions of international travel starting in August, meaning when the resumption of normal international travel starting August 1, this will boost cargo space for exporters. And as you know, this was a constraint, or had been a constraint, which has been easing. But an interesting thing here is that over the last 4 weeks, freight costs have more or less normalized. Remember about a month ago, a little more than a month ago, freight costs were at times double the regular cost. So now they are more or less normalized, although some airlines are still placing a margin of about 5 to 10%. But definitely the pricing now in terms of freight charges is much more appropriate as this return to normal and with the easing of the international travel. That's all I want to say about the exports in general, but I want to mention a couple of things on remittances. This improved in June, and the number we had then was 288 million US dollars in June, which is higher than, which was an increase from 200 in May. It was 258 in May, US dollars. Now, it's interesting that this number in June, the June number that we had, the one I just quoted, 288.5, that is the second highest all-time, highest remittance per month that we have received. And the highest remittance, the highest all-time record is actually June of 2019. June of 2019. So what we are saying here is that we had expected, we were projecting a decline in US dollar terms of remittances of something like 12.3% decline. The World Bank and others have generally been projecting declines of something like 20% around the world, remittances. And I think the argument there is clear that we have diaspora in the advanced economies or economies that were shut down, and therefore they're, like everyone else in those economies, they'll be affected directly. Their paycheck would be eliminated. In a sense, they would have trouble earning what they were earning before, which may lead to declines in the remittances that they send home. What is clear is that we haven't seen that, and if anything, we have seen a sort of a continuation of the trend that was there after the dip that we saw 3 months ago. So yes, there was that month where there was a dip, but then it has recovered subsequently. So we have revised our projection for the remittance, so to more or less 1% increase, aligned to the year-to-date growth of 0.87%, something like that. So instead of a decline of 12%, we are projecting now a modest increase for 2020. Bottom line, putting all these things together in terms of the changes in exports, changes in remittances, maintenance of the various things we talked about in terms of oil imports and other imports, we have revised our expectation or our projection of the current account deficit for 2020. And this is now projected at a deficit of 5.1% of GDP, which is a narrowing from what we had projected and we announced last month of 5.8% of GDP. That's what we were projecting for the year 2020. Clearly, this strengthening of the current account or narrowing of the current account deficit portends to stability in the foreign exchange market, and which is what we expect to see and have seen through this period. I think you do understand the level of reserves that we have. They were indicated in the press release, and the precise number from 2 days ago was 9,350 million US dollars in terms of FX exchange, which is something like 5.67 months of import cover. And as you can imagine, that is adequate for the purposes that we hold reserves. But I think it's also important to understand that that stability is something that is aligned to our foreign exchange policy, or should we say exchange rate policy, which we have repeated to you again. We only intervene to minimize volatility. We don't have a target of the rate. The direction is determined by the market, and we will intervene to minimize volatility and maintain stability in terms of financial stability, because volatility we all know is quite disruptive in terms of our financial sector, etc. Now, in terms of where the exchange rate is today, I think all I can say is have repeated our foreign exchange policy. But I think since the COVID period, so April, July, yes, the currency has depreciated about 2.4% against the US dollar. And we have other currencies that have depreciated less, or actually many others that have depreciated more. And there are some that actually have appreciated. So we are closer to the middle. I think these are graphs that we can provide to you, and you can always calculate it yourself. But what about from January to July, January to date? Well, we have had a depreciation of cumulative 6.3%. And again, the other currencies, I'm not going to quote them, that have depreciated a lot more, and a few others that have depreciated less than we have. I mean, the euro actually has depreciated by 4.5%, and yes, and actually I was going to mention the pound, and the pound between January to July has actually appreciated by 2.5%. Anyway, those are numbers that you can calculate, but we are not concerned about these numbers. We still think that these numbers are appropriate in the circumstances, and that's what the market is saying, and all we want is to minimize volatility. Moving along, there were two other things that I probably could mention now. One is the banking sector, and that I think I don't want to say too much, except that the restructuring of loans that was started in March has continued at pace, and now we have the numbers that were quoted in the press release. Something like 30% of total banking sector loan book have been rescheduled. And I think that is phenomenal. And at the same time, we know that NPLs have gone up by, or have remained around 13.1%. That's the number that also we quoted. But this is relating to the loans that were already under watch at the time of the COVID crisis, which is before March 2nd. So, but anyway, the numbers are there. We are confident, as we said last time, if the borrowers could go to their banks and have that consideration, have that conversation with the banks, showing how the COVID pandemic has affected their cash flow and all that. I think that is the discussion we want banks to have. Nevertheless, we do appreciate that there's a lot of liquidity in the system, and the liquidity has really, partly because of the release of or the lowering of the cash reserve ratio. If you remember, we said that we released about 35.2 billion, and so far about 90% of that has already been used to support lending, as we had said, as we had indicated before. But the dominant driver of liquidity has been the government's injection through, say, payments of pending bills, and also through the various COVID response measures that they have put in place. And that is something, obviously, that we are watching. And from our side, we want, even as these injections comes in, we are mopping it and maintaining some stability in this. But what is clear is that has led to significant liquidity in the system, and that has also led to, for instance, large, let's say, record bids in terms of amounts of bids in the government securities market. In terms of the government securities market, now that I'm there, I think the points are clear. We've tried to provide stability in the yield curve through a mix of alternate tenures that appeal to different investors or investor appetite. But at the same time, what we have been doing is to lengthen the average time to maturity. This is a policy that we started about a year and a half ago, 18 months ago maybe, around then. And since then, the average time to maturity of bonds has lengthened from, let's say, 6.1 in June of 2018 to currently 7.8 years as of July 30th, which is today. There has also been other things in terms of the ratio of T-bills to bonds. The point is here, in July it was 29 to 71, with bond maturities well spread or well distributed and extending out up to 2044. So these are all things that are happening in the government securities market, in the primary market. Obviously, when we put out those, when we consider where to place those primary issuances, we are considerate also of the investors' appetite, and particularly at this time of the COVID period. So that's why we are presenting a menu of options, cognizant of that it's a time of some unsettled, let's say, unsettling period. At the same time, we need to emphasize that that we do have a net domestic borrowing target that we and Treasury agree on, and that is a number that we will obviously look at and work towards, as we did last year, where we hit the number at the end of the fiscal year. We pretty much hit it on the button, and I think that's what we intend to do going forward. Finally, one word about the government responses in terms of the COVID response. But now we are talking about the economic response, not the health response. And this has been going at pace. And this was one of the reasons why the MPC did not make any change in the monetary policy stance, but decided to maintain the stance that we have had until now, and to allow the measures that the government is taking, fiscal measures, to work through the system, meaning to take their effect. And as we know, this takes time for it to really percolate to the everywhere in the economy and really produce the intended effect. Nevertheless, this is all part of the economic stimulus package, which was approved in June, and something like 56.6 billion, that's the total. But I wanted to highlight two specific programs that you may have seen or heard about. And the first is the Kazi Mtaani, which is a program where youth or young men and women work, do some community work, cleaning, cutting grass, cleaning trenches and things like that. And I'm sure you've seen them, in your neighborhoods and around the country. At this moment, they have something like 230,000 people, individuals, participating in this in particular ways. They come in for 11 days and are paid something like 5,000 Kenya shillings. And the idea here is to rotate it as much as possible. The other one is a program that is aimed at the most vulnerable in our society, the newly vulnerable ones. And this, at this moment, has a number like 342,000 people. And this number will be increased to about 670,000 people. And these are the vulnerable people. And they are getting something like 1,000 Kenya shillings a week. And for a certain number of weeks, and then they are weaned off it. The payments are sent to them by phone directly, so there's no sort of middleman in that sense, and therefore they can use those funds as they see fit. So those are the things I wanted to mention. I think today maybe have done a lot more in terms of data and things like that. But I think it is worth every now and then to present to you the underpinnings of some of these things. So I'll stop here, and I'm open to your questions.
So that, just to remind you, if you need any reminding, was the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge. And as we usually do, we will take a number of questions coming through from you, the members of the media, plus other people, analysts and the like, who have been listening in. I'll begin with just one, Governor, and then I'll give you another batch, which is from Gerald Gekara of Uzalendo News. Gerald is asking, a report by the CBK showed that many Kenyans have their cash in their pockets without use. Those are his words. Since the virus hit Kenya, can this impact the economy negatively?
Okay. Gerard, I don't know exactly which report you're referring to, but I guess the point here is that cash in our pocket, that really, it's a response to our own uncertainty as well. So in some sense, you have what you may call precautionary savings. And so I don't know whether I'll have my job next week or next month. So what I'll generally do is to save much more aggressively, because the outcome that of me being jobless next month is not something that I want to be sure that I can survive, I can ride through that storm. So in some sense, this makes sense. And actually, we've also seen it. People have increased their holdings of money in their e-wallets. For those of us that have all these gadgets and have e-wallets, M-Pesa and the like. So I think this is something that is expected in terms of the emergency, or should say precautionary savings. Is it something that we expect to be sustained forever? Obviously, once the people have saved to a particular level, they'll continue consuming. But I think the point here is not to worry about that issue, because that is actually good behavior. That is completely good, cautious behavior. You don't want to consume everything all at once. And if there is anything that, Jared, we need to do better going forward, is saving. Saving. You talk to people around the, young men and women, and the savings culture hasn't quite permeated to them. So they are very much going from paycheck to paycheck. It may be a relatively large paycheck, but that is something, obviously, that we need to do more in the long term.
All right. The second batch of questions, at least now we do perhaps more than one. I'll begin with Dominic Omondi. Dominic Omondi is from The Standard. He's asking, the World Bank and the IMF have projected a contraction of the economy should the containment measures go beyond June. Do you agree? The second one in that batch is from Kefa Moirori of Radio Citizen. What is CBK's new GDP projection for the year, an outlook on economic activity given the receipt of the Q1 GDP already? The third and last one is David Herbling from Bloomberg News. David is asking, did the MPC use all its firepower too soon in the previous successive cuts? What array of weapons do you still have in your arsenal? Very martial question from David Herbling. Okay, so we are getting technical problems here, so maybe I just go one after the other. Yeah, so let me just, I hope you got Dominic's. I'll just repeat Dominic's while we sort that out. Dominic Omondi was asking, the World Bank and the IMF have projected a contraction of the economy should the containment measures go beyond June. Do you agree? Okay, Dominic. Oh yeah, now I see you. You're here now. I think the point is this. We are doing our own projections, and the IMF and World Bank and yourselves as well can do your own projections. I don't think the issue here is to say who is wrong, who's right, or whatever else it is. We believe we are right, meaning we use all available information efficiently and using our judgment, and we then make our projection. We don't do it and then hand it over to somebody else who will then check and tell us whether they agree or disagree with us. We've always acted that way. If there's anything we are really proud of, we are proud of our own training, and we also are proud of what we have put out there, and we can explain it to the last decimal or the last penny. Just now I gave you a whole array of data that we will use in terms of putting together the projections, our GDP projections and things like that, and using other information that maybe we did not say. So I cannot defend or criticize numbers that other people have done. I mean, what we need to do is to have a face-to-face with them and ask why this number and that. We've done that before. So Dominic, I think I'll just let that go and then ask you. Very soon we'll be putting out our own projections. You could probably ask, why are we slow in putting out the projections? And my question is, I don't know what slow is. Meaning, maybe we have been doing this at pace, and you cannot really push on a string. Everything has its time, as it were. So let's wait and hear from us as soon as we have the correct numbers, our own projections. So that is Dominic's, right? And actually it also answers Kefa's question, which is what is our new GDP projection. Kefa, please be patient. We'll be coming back to you on these numbers, I hope shortly, and we can discuss them once the numbers are ready. Helbring asked, did the MPC use all its firepower too soon? I don't know about that. We have plenty of firepower, plenty. And the issue here is we wanted to be quick. We wanted to be quick.
Why? Well, first and foremost is monetary policy can work sooner, or in terms of being put in place. It's not constrained like fiscal policy at times is. Now, that is not quite true, because in fiscal policy, you do have automatic stabilizers, but that will take us way out, way away from this. So in effect, monetary policy, we were able to move quickly and thereby stabilize the economy early on. That is important. And you can already see the benefit of that. If we had waited, we would have had chaos, because there wouldn't have been a sense of a coalescing point in terms of policy. And so it was important for monetary policy to move quickly. And David, I am sure you have looked at other countries as well. Other countries, the monetary authorities are also the ones that have led the charge, meaning moved quickly. But the fiscal authorities have actually come, and they need to come and support the recovery in particular ways. You ask about the array of weapons. Well, we still have plenty of those. They are the same ones we had at the beginning. So yeah, and we are willing to use them as needed, if needed. And but at this moment, as we said, the MPC judged that it is best to wait to see the efficacy of the policies that have already been announced by the fiscal authorities. And that is important. It is important to allow that to work its ways. And I've already dabbled into them. I have explained some of them. So I'll leave that there. So I've handled all three questions.
Yes, excellent. The next batch, I'll begin with Razia Khan, who is the Chief African Economist for Standard Chartered Bank. Razia is asking, there has been a good take-up by the banks of the emergency liquidity relief so far. So she continues to ask, how confident is a CBK that bank lending can proceed on the necessary trajectory to help the economic recovery? Is there a case for further policy easing? The next one is from Gibran Qureshi. Gibran is the head of Africa Research at the Standard Bank Group. Gibran has got a question about, well, let me just read the question. Admittedly, the current situation still remains highly uncertain and fluid. But in light of the resilience within the economy and broad improvement in the agriculture sector, do you see GDP growth higher than your previous estimate of around 2.5%? That's Gibran Qureshi of Standard Bank. The third and final one in this bunch is from Jimmy Mbogo of Business Hour. Jimmy asks, of all the loans that have been restructured, how much did the SME sector account for?
Okay, let's take them in turn. So the issue here about bank lending, I guess, presumably to the private sector, whether that will deviate from the trajectory that we indicated. Sure, it may decline, meaning it may not proceed exactly as we had projected for the year. But our point is that we do expect the credit to return, also because of the measures that we have put in place, right? So the restructuring, by the way, part of that may involve additional lending, particularly when the recovery begins to take place, quote unquote, post-COVID period. Now, we are talking of the post-COVID period, but that means in the next couple of months, really, because the economies are reopening. The economy is reopening. I've talked about how even in the hotel sector, there is now sort of a glimmer of hope. So what maybe we were expecting to happen much later in December may happen sooner. But the point is, sure, there will be a need for credit. As a matter of fact, an interesting number, which I did not quote, is credit to the manufacturing sector. Maybe I should quote it. Yeah, but to quote it, the first thing I need to do is to find it, and it is here. So if you just give me 1 second, I'll find it. Yeah, there it is. Evolution of credit to the manufacturing sector. Actually, in the month of June, it was 12.3% higher than in the same month last year. And in the month of May, it was 18% higher, and so forth. So actually, right through January through June, all those are large double-digit growth relative to the previous month last year. So there is credit growth, and there will be more credit growth. So we are confident that that will happen. But I think it's dependent on the recovery, and also dependent on another element, which is the SME, strengthening of the SME. And in this, a key element is the SME guarantee, the SME guarantee scheme, which we hope, we expect to be put in place very shortly. We are not talking weeks, we are probably talking days in terms of when this will be put in place. So all these factors, also the optimism that, the increase in optimism, the more optimistic scenario, or more optimistic outlook by economic agents in the country, all that will lead to lending, increased bank lending. The question is there a case for further policy rate easing? I mean, I just said what the MPC indicated, but I think the MPC is ready to do whatever it takes. But I think at this moment, knowing that there is a lot of pressure, there's a lot of liquidity in the system already, and there's also the fiscal measures that are working through the economy, it didn't seem like there's a case, or the case for further policy rate easing was weak. Jim Brown's question about GDP growth projection today. Well, I would ask you, Gibran, to just be a bit patient. Clearly, there are some significant, let's say, positive numbers that we are talking about, but I don't want, in some sense, to state something, a number, that later on we kind of say, no, it isn't quite that. So please be patient, give us a bit of time. We'll come back with better, let's say, our firm position, what that is. The question about the SME sector, there has been loans that have been from the SME sector, but I don't have the numbers here. I didn't bring them with me. But you should note that a lot of the loans to private sector, to the households, a lot of that is actually SME lending, or a significant portion of that. There is SME lending that goes in there. But at this moment, I don't have the specific numbers. But the only point to add here is the SME credit guarantee scheme, which obviously will be very supportive for this sector.
All right. But there's something very unusual, and perhaps I need to point out to you, Governor. Razia Khan said thank you, which people rarely do when they're asking the question. She said thank you for the answer to the question. Be that as it may, we move on to another batch of questions, beginning with Dominic Omondi from The Standard again. And Dominic is saying, CBK noted in its weekly bulletin that the weakening of the shilling was due to increased demand for dollars in the interbank market. What drove this demand? The next question, back to Gibran. He's asking, is the government still keen on securing an SBA, that is a standby arrangement, with the IMF? Is there any update on this? Jimmy Mbogo asks, what is the status of the regional currency? Is the discussion still ongoing? And what is the risk of a regional currency in terms of valuation globally? The last one is back to Kefa Moirore from Radio Citizen. Should borrowers be concerned about a lockout as liquidity continues to flow to government securities? Private sector credit in 12 months is already on a downward trend. That is the next batch of questions.
Okay, maybe taking them in the order that you've presented it here. So Gibran is asking of the status of discussions, let's say, or the government's view in terms of securing an IMF arrangement, an arrangement with the IMF. And all I can say is this has not changed from before. It remains the same. That, yeah, we are obviously interested in discussing or continuing discussions that would lead to an IMF facility of a kind. But this would be a precautionary arrangement. That's probably what you're saying. But I think the point is there has been a lot of other work that we have been doing. So in some sense, Gibran, we've been busy. And I think that is quite clear to those of you that are looking maybe the, you know, how long hours we are pulling and things like that. So yeah, that hasn't changed. There's no additional update. It will happen in due time. As we have said, we are going to work here, or we are going to walk into this according to our own terms, and then you'll hear more about it as we go forward. The question about the weakening of the shilling, I just mentioned the numbers. I don't know what you mean by what drove this demand. I assume there are people that are using the Kenya shilling or buying the US dollars for imports or making payments like that. So I cannot tell you who the demanders were, who are buying US dollars in the market. But what is clear is that there was an increase in demand during that period. And again, this is a matching, right? Some weeks you have a balance on the other side, meaning an imbalance rather, where you have, or maybe here you had an imbalance from the perspective of importers, because there was only so much that was coming in. But at other weeks, you actually it goes the other way, and you have a significant inflow. Let's say that's when we are getting money from what KTDA is, or tea, or exporters are getting their, whatever it is, they're getting their foreign payments coming in. All for that matter, that is a time when there is some other significant, let's say, transaction in the capital markets or whatever else it is. So that is the essence of a market, Dominic. So it's neither, on a day-to-day basis, you cannot always have equality. I hope we understand that. So it is actually looking at it over a period of time, a week, a month, and then you see that the imbalances even out. But every single moment, you cannot have a balance in any market, as we understand. The regional currency is where it was. There hasn't been any change. I mean, frankly, we have been looking more into, I mean, this is the most significant economic shock that we've ever had, right? So we've been focused on it. And most of the other things, I mean, discussions about regional currency, those have become second order. Why? Because this is an economic, it's an existential sort of question that we are dealing with, you know, economically. So we have to deal with that. We need to focus on what is most urgent, and as I would also say what is most important today. And what is most important today is to overcome, is to ride through this crisis, economic crisis, as well as we can, as well as possible. Njoroge asked a question, Kefa, should borrowers be concerned of a lockout as liquidity continues to flow to government? I don't know. I don't know where this sense comes from. There's a lot of liquidity there, as I mentioned, right? A lot of liquidity. It's true. There is actually a lot of liquidity that would want to park itself in government securities. In some sense, financing government deficit and so forth. But as we have said before, that is not a sort of an elastic demand that is there. It is fixed. We talked about what it was last year, right? Last fiscal year, we gave you the number to the last penny. And we have a similar constraint now. So if it is 400 and something, whatever it will be, or whatever it is, that is what we are going to borrow and nothing more. So everything else will have to go elsewhere, which is to go into lending for credit. So this sort of in some sense shutting out, as you called it, in our jargon we call it crowding out. So crowding out the private sector is not something that has happened. I mean, look at what has happened over the last 1 year, or the last 2 years, the last 3 years. There wasn't any crowding out, but yet we still get this sort of drumbeat of crowding out story. No, and the drivers of the economy of Kenya are actually the private sector. So if we want things to happen, it has to be the private sector. So credit has to go correctly priced and all that to the private sector. Anything else?
Just looking through all the platforms to see whether there's any other question that's come. Actually, none, but just to remind Duncan Mereri from Reuters, Kefa from Radio Citizen, Jimmy Mbogo, and David Habling, who have all sort of within this period been asking about the growth rate, projected growth rate, questions of that nature. I believe the governor has answered those sufficiently with regard to that question. So that is it. Just checking that anything new has come in, which the answer is no, nothing new has come in. So that is it for this press briefing, and basically briefing to all of you that have been watching in this morning into this afternoon. A reminder that as per the press statement that was issued yesterday by the Monetary Policy Committee, the next meeting is scheduled for September. If you remember, the MPC has been meeting monthly since March, but it's reverted back to its 2-month schedule. But as it said, if there's any reason to meet before that, that would happen. But the reason why I'm putting that out there is to let you know that the next press briefing expected would be towards the end of September after the next MPC meeting. But for now, thank you for joining us. Thank you for your questions. Thank you for participating in this post-MPC press briefing from the Central Bank of Kenya. We shall see you at the next one. Thank you very much, and good afternoon.